Hey there, it's J-Rod here for Rich Retirement TV, and before we dig into today's video, which will be my last one until the new year, I just want to say thank you so much for watching my videos and for being a part of the special community we have here at the Rich Retirement Letter. My colleague Zach Scheit and I, we love helping you build a retirement of your dreams, and we wouldn't trade our sweet gigs for any other in the world. So thank you so much. 2020 has been a hell of a year to say the least. But if you follow my videos here at Rich Retirement Letter, you've had the opportunity to book some serious profits this year, like a 166% gain on Maxar Technologies, 152% gain on GoGo, ticker GOGO, in just 21 days, and a 130% gain on Sunrun, just to name a few. Not here to boast, mind you, but there are plenty more of these types of opportunities headed your way. And to set you up for 2021, I'm going to do a special update to one of my most popular videos here at Rich Retirement Letter. For 2021, here are my top 3 tech income stocks for 2020. All right. So the first stock on my list is HPQ. They're a computer maker, as you probably know. They focus on enterprise computers, and the stock is soaring as companies and consumers alike beef up their work-from-home setups. The company right now boasts a 3.25% dividend yield, so just over 3%, and they're paying out only 44% of their earnings on dividends, which is a really good number. Typically, I like to see companies paying out less than 50% of their earnings on dividends. That's a real indicator of a safe dividend. But it's also, when you have that kind of buffer, you have room to increase your earnings, boost your earnings, or your dividends payouts rather, as earnings grow. So HPQ, one of those names with just a 44% payout ratio. It's a cheap name too. It's trading at just 8 times forward earnings compared to the S&P 500, which is trading at about 24 times forward earnings. So you're paying 3 times more for the S&P than you are for HP on an earnings basis. And in terms of price target, I'm targeting $35 for HPQ over the next year or so. You take a look here. The stock carved out this range here really in 2020 between $24 and $14. So you take that $10 range, you plop it on top of this breakout here above the about $24 here, which is just above the high here in 2020. That gives us $35 target, and that's 40% upside from Tuesday's close. And then you tack on the 3% annual dividend. A lot to love here in this rebounding, soaring tech name. All right, second stock on my list, Texas Instruments, ticker TXN. They're a $148 billion chip maker. You probably know them. I grew up, with their calculators, the TI-83 calculator in school. But they're a chip maker with products all over the place. They're a big data center play right now. So in the places in the cloud networking space and the server space, they're a big name. And they're also a big name in the automotive space. A lot of their chips power the internal components of today's modern cars and whatnot. So a lot to love here just in terms of who Texas Instruments is. But we talk about what do I love about Texas Instruments right now. It's dominant. It's one of the biggest chip makers in the world. They're the largest digital signal processing chip maker in the world, which is wireless communications. It's the majority of their revenue. They've carved out a very wide moat in what they do. It's competitive, but they've got a lot of room where they are. But yeah, in terms of the stock itself, it's another cheaper name. It's It's trading for 27 times forward earnings, but compared to their competitors, like say Broadcom, is trading at 45 times forward earnings. You've got, it's much cheaper than the rest of the semiconductor market. And it's under momentum here, as you can see. You take a look at the stock, it's just surging here. It's also carved out a really nice range here between 135 here. Let me turn on my lines here so you can see it. There we go. So it's carved out a range here between 135 and 95. Through the first half of 2020, and over the summer broke out of that high, or broke out of the top of that range there, and that range from 135 to 95, that's $40. Slap that on top of 135, that gives me a 175 price target. But again, as you can see here, not only has the stock broken out strongly and rallied, ever since September when it popped above this range here, it's got really strong support here along the 50-day moving average. Every time we pop down, every time the stock pulls back here to this red line, that's the 50-day, it springs back up. So you've got a lot of support here, a lot of momentum. Semiconductors in general, the industry is pushing forward as, consumers, regardless of the pandemic, are beefing up on their consumer tech. They're still buying cars. They're still buying cell phones. There's a lot of momentum here for Texas Instruments moving forward. So, and as you can see, it's been making just over the last couple of months here, it's been making pushing to new all-time highs. A lot to love here in this momentum name, but yeah, they pay a 2.5% dividend yield, and they're paying 67% of their earnings out on dividends, which is a little bit higher than I'd like to see, but from such a dominant name, I think that's well all right, and you'll make up. They're going to still a lot of room there. Got a lot of momentum pushing this stock forward. So in addition to the dividend yield, you'll see nice appreciation here with these shares in 2021. And last on my list, Docs. It's Amdocs Ltd, ticker DOX. And this company, if you're unfamiliar, they're a cloud-based digital billing and customer experience software company. They basically they work, facilitate services for different businesses, like a business to business type software as a service type company, and they count Google, Amazon, and Disney as just as customers, just to name a few. But what Amdocs as an income stock. They pay a 2% dividend yield, and they're paying just 32% of their earnings out on dividends. That is a phenomenal number, especially for a tech company. It's at the very low end of the scale. And like I was saying, before, companies that have a low payout ratio of earnings to dividends, they have room to boost their dividends, especially companies like Amdocs that is in a growth industry. Software as a service, cloud-based, back office services. This company is in an explosive sector of the market, and because they were paying out so little of their earnings, and earnings are expected to grow phenomenally in 2021 and beyond, they've actually boosted their their dividend payout 10% for 2021. The first of those payments will get doled out here in April of 2021. So a lot of strength here. What do I love about Amdocs on the chart here? You take a look, stock broke out here of this, the dotted line here. That's the top of the range that it's carved out for the majority of 2020. It's about $68. And you see here at the low, it's right around $48. Let me get myself out of the way here. But Yeah, so it's traded sideways for a decent part of the summer and into the fall. But as you can see here, this line here, this solid line that comes down here, that represents a downtrend, right? You see, Amdocs made a series of lower highs as it moved forward. The blue line here, it's the 200-day moving average that was curved downward, and the 50-day moving average, which the stock fell below. Again, trend pointing downwards, but you see here in November, here, the stock breaks out big time above retakes the 50-day moving average, retakes the 200-day moving average, that's the blue and the red lines respectively, and soars after a killer earnings statement, and then breaks above that $68 range here, or that $60 upper end of the channel. So you take that range. My price target for the stock at this point is $88. So that's the $20 range between 68 and 48 here, tacked on top of $68. But yeah, so you've got a series of breakouts here, and here you've got a golden cross here where the 50-day moving average crosses above the 200-day moving average. Another sign of bullish strength for the days, months, and even a year forward. So big breakouts here, big dividend, a lot to love. When all three of these stocks, again, they're tech names that pay dividends, right? HPQ, TXN, Docs, they're paying out dividends in a sector of the market that doesn't really pay dividends, right? It's provided a big boost to retirement counts all over the world, in technology being the dominant sector over the last 10, 20 years in the market. But few of these companies pay dividends, and even fewer pay dividends and also exist in growth segments of the market. But all three of these companies tick those boxes. Each one of these are paying a really juicy dividend and should see decent, if not great, capital appreciation on the shares. That is just percentage growth in 2021. So a lot to love here. Take a look at these names and enjoy. And so again, on behalf of Rich Retirement Letter, I'm Jay Rod. Thank you so much for watching. Have a happy holiday, and I'll see you in 2021.